You've gone ahead and put the link up on Twitter Spaces, correct?
Yes, I am just opening up. It says FX Flow cannot be invited. All right, I'm going to ignore you. I'm trying to invite Boris as a speaker here. Just give me 1 second because I can only
Of
do
course.
it once I open up the chat. Okay, yes.
No
All
problem.
right,
So we're live
so
on YouTube and on Twitter Spaces.
and now I'm going to drop in the YouTube link into Twitter Spaces. So for those of you that are on Twitter Spaces, I know we just kicked off. I'm going to add in watch our charts on YouTube Live. Oh, okay. So that's there as well. Great. And you probably, all right, so it looks like everything is good to go. Ready to rock and
Excellent.
roll, Corey?
Awesome, awesome. Well, thank you guys so much for joining us. I know it's been about 2 weeks. We had the holiday last week, so we've got a lot to cover. But what's going on? How have you guys been?
Things have been great. I mean, markets have been busy. I think, overall, we're, happy. We've been talking about how there was, in my opinion, zero chance that they were going to let the U.S. economy default, right? And they were going to reach that debt deal agreement. Finally happened. And I
Yep.
think that removes a major uncertainty in the markets and, allows for, more directional trade, I believe. It was a little bit of a back and forth as everyone was watching headlines. But when you have such a big uncertainty removed, I think, that allows for trends to resume. So I'm happy to see that. Markets are, rocking and rolling again. And we're moving into a month where we've got a lot of big central bank rate decisions. And so I think, it's going to be a very, very exciting month.
Awesome, awesome. And what should we be looking out for this week in particular?
Well, we don't have much in the way of U.S. event risk. We obviously came off of the big non-farm payrolls report on Friday,
Hmm.
and we're coming off of robust gains, a very strong month for the U.S. dollar. And this week we had the most important piece of data that has already come out this morning, and that was the ISM services, and that number was weaker, telling us that the manufacturing and service sector, a part of the economy, is slowing. So that is going to give us insight into what the Fed will do when they meet next week. And we can talk about that later. But this week in particular, we have the Reserve Bank of Australia and the Bank of Canada monetary policy announcements. Both central banks are expected to leave rates completely unchanged. But they aren't done. I think that that's the message they're going to leave with us after their rate decisions, which is that inflation, the biggest problem around the world, is not up. We hear that from the ECB today. We hear that from a lot of people in Australia and Canada in particular. Inflation expectations have been very sticky. So while they're widely expected to do nothing this month, I think the guidance will still be hawkish, which could be one of the reasons why Aussie and CAD are still firm and doing so well. Now, between these two, I would have to say that the Bank of Canada rate decision is probably a closer call because data from Canada has actually been very good. The labor market's on fire, inflation is really hot, and oil prices are back above $70 a barrel. Saudi's oil production cut this morning or overnight was really big news for the oil market. That drove oil prices higher. So, the relief that everyone had been hoping for in the summer driving season is not happening. So I think, the BOC between the two will probably be the more hawkish one. So, we've got two rate decisions this week, and then next week we have ECB, I believe, as well as FOMC. We definitely have FOMC. So I have to check my calendar on ECB. But regardless, those two are going to be the marquee events of the month. And these are going to be big, great decisions.
Sure, sure. And what are the expectations for FOMC? Well, I know it's been
So
bouncing back and forth for a while now.
yeah, so this is a really interesting question. Over the past couple of weeks, we've been talking about looking at the Fed CME Fed Watch tool. So that's what I want to share with you right now. For those of you that are on Twitter Spaces, you need to hold on, let me get the screen first. If you're in Twitter Spaces, you need to go onto the YouTube link so that you can see what we're showing. And do you see my CME Watch tool right now? Is
Looks
my
like it's
screen
loading. Yep,
showing?
it just popped
Yeah,
up.
yeah. You see it.
Okay,
You see it.
fabulous. So, this is a really interesting thing about the price action in the markets, which is that we have that really good NFP number. But take a look at this. What is this telling us? The market is still looking for a 76% chance of no change from the Fed next week. And if you look at the very bottom, it says one day, I don't know if my mouse is going to show up. Yeah. One day, which is Friday, those rate expectations were pretty much the same. And before NFPs, I think they were right at 70% chance. So believe it or not, even though we had the hot jobs number, the chance of a rate hike next week actually fell. So everyone's wondering, why in the world is that happening? And I think that it's because everyone is leaning more on what the policymakers are telling us. So rather than what the numbers are telling us, they're paying more attention to what the voters, the FOMC, are saying. And two pretty important people, as a part of the Fed leadership last week, made it very clear that they stand on the side of skipping a June rate hike. They said, it's not a pause, it's just a skip, and they favor skipping. And one of them is actually, a vice chair nominee, so he would be very influential if he got the post. So they said that they favor skipping because
were those both voting members?
Yes, they're both voting members. That's why it's so important. And they said they want to see more data, which totally makes sense, right? Because inflation kind of looks like it's falling, but it's not really. And then the labor market is strong, but they wanted to see how much stronger could it be, and we saw the NFP number. So they probably want to see another inflation report, another jobs report before pressing the button on another rate hike. So this week, Corey, we're actually in what we call the quiet period, which means that we're not going to hear from any more Fed presidents. They're not allowed to speak the week before the Federal Reserve rate decision. That's a hard, fast rule for the central bank. So we're left with this. We're left with the parting words of skip versus the NFP number. And so you can see that the market is leaning much towards what they're saying rather than what the numbers are showing us, and showing us 76% chance of no change in June. And that's the reason why Corey, think that the U.S. dollar is getting tired this week. I think we're going to see profit taking in the greenback. I think that you're going to see the greenback ease its gains because we're ready past the number one piece of data this week, which is ISM services, and that was not good. That was weaker. And then we really have not much else from the U.S. this week. So everyone's going to mull on the weaker ISM, weaker service and manufacturing numbers, and then the skip word used by Fed policymakers. So I think that the dollar is going to pull back this week. I think that we're not going to see rate expectations help the dollar at all going into next week's decision.
Great analysis. Thank you. So what's the play here? Are we short the dollar?
So I like selling dollars. I think, let me go to my other chart here. I think, sorry, these drawings are so old. So I like two things. I like dollar yen for pullback down to these lows here, 138.50 in the near term. I'm not saying obviously that the dollar rally's over. I just think there's profit taking, and I think we're going to see the dollar pull back. So I think dollar yen's going to sink down to 138.50. I like euro. I think that euro could move back up to 108, 108.50 because while the Fed is talking about skip, the ECB every single day from ECB head Lagarde, she's telling us that there's no reason to believe that inflation is going to stop rising. We really think that another rate hike is necessary. She's being uber hawkish, whereas the Fed is being more cagey. So that I think should help the euro, kind of rebound off of the recent lows that's had.
Awesome. So two great plays here for the coming 2 weeks, I should say.
Yeah, I mean, the Fed rate decision is mid next week, so you've got a good opportunity ahead of that.
Excellent. And Boris, what do you have for us?
Well, I think profit taking may be the course of action in equities as well. I'm looking at maybe. Yeah, are you done sharing the screen? Okay, can I take over the screen?
Go ahead.
Okay.
And for those of you that are on Twitter Spaces, make sure you hop on to YouTube because that's where we're sharing our screens.
Okay, you have to stop sharing. You just have to.
Okay.
And also, guys, you could ask questions over on YouTube as well. We're monitoring YouTube for questions. You could ask questions on Twitter Spaces also. Feel free to jump in and ask some questions. We'll get you some great analysis today.
All right. Well, I'm looking at this is the 1 minute chart, so obviously It's only for degenerate traders like myself, but generally, we had a very, very, very strong move in US 30 in the Dow on Friday, like a 2% move. I think just took everybody who was short out of the market. And it's very, very natural that we have a little bit of a retrace coming out. But what I find really interesting, and I kind of wanted to ask Kathy about this. So we have this, we have effectively a very positive monetary background, because I think almost everybody's convinced that the Fed is going to skip, right? That means interest rates stay stationary as positive equities, against a negative growth background because ISM services, manufacturing are slowing down. And it feels like there's kind of a tug of war in equities, where NASDAQ right now, as you can see, is positive, US 30 is negative, where the older economy companies, which are much more dependent on demand, like final demand, where their profit margins are much thinner, kind of not doing as well, because they're afraid that consumer demand is going to start to curb itself. Whereas high technology companies, which are really sort of cater only to the top 20% of the population that doesn't really have any problems, and are much more sensitive to higher interest rates, are doing much better. So you have this bifurcation, really kind of a bipolar action, where the NASDAQ is up and the Dow is down. And I think it explains probably the fact that it was monetarily positive, the data today, but economically negative. So Dow, which is much more negative, is reacting to that effect. The other thing that I think is really interesting in markets today is the fact that how weak oil is relative to the big Saudi announcement. Saudis come in here, announce that they're going to take off 1 million barrels a day, and oil does nothing but just kind of it gaps open on the let's go to the 15-minute chart. It gaps open and just distributes, and we just filled the gap basically from Friday. And I think that's indicative. And the fact that the Saudis were actually willing to take demand off, I think is much more indicative of a desperation of the market. Talks to the desperation of the Saudis that it does to any kind of bullish move in oil. That having been said, I've been what I would call a careful or a cautious bull in oil. And the reason why I've been a cautious bull in oil, this is the 1 hour chart. Probably let's go to the 4 hour chart. Maybe even like the daily. I just want to pull out a little bit more. Yeah, this is our daily chart. And I said to everybody, as long as we keep making higher lows, it's pretty bullish. And essentially, as long as we don't break the 64s, that's pretty bullish. And what you're seeing here was a lot of negative movement, but we held the lows. And now, post the Saudi news, we kind of hold kind of trading highs. So it's not like oil is a screaming buy, but it's also definitely not a screaming sell. There is a clear area of support here in the 65 zone. And I think the smart trade here still remains to the upside. I don't know how much upside we have, maybe 74, 75s, but selling here puts us much closer to support. And only if you have sort of a very, very negative depressionary type of a scenario where demand for oil really comes down, can you imagine oil trickling back down below 65s? I mean, it's totally possible. That's why if I'm wrong, the stop would be at under 64s. But overall, I think this is still a buy to dip story. And generally, we haven't broken any major technical support here to make me change my mind that we have a cautiously upward trending instrument at this point. Gold, on the other hand, is a dog. My friend Jason Shapiro, who is a market wizard, great guy. I highly recommend you guys follow him for sentiment analysis. He spends all his time basically betting against the crowd. And about a month and a half ago, he said the single best trade is long equities, short gold, because everybody was bullish gold. I remember how everybody was bullish gold, and everybody was bearish equities. And it turned out to be like one of the best calls of the last quarter. And you're really seeing, gold just kind of die out here. Like gold is doing the inverse of oil. It's distributing. If oil is supporting at the 65s, oil is really distributing at the 2100 level. And there's nothing here to make you want to be bullish. In fact, this is a sell the rally trade continuously.
So,
As I said,
Boris, can I ask you a question? What was his argument for long equity, short gold? Can you explain that?
Yes. So he tracks the Commitment of Traders report, which is every single week the Chicago Mercantile Exchange. I wonder if I can pull. Next Monday I'll bring up the COT. Just like you bring your little CME tool, I'll bring the CRT tool. So the Commitment of Traders report basically takes the positions of everybody in the market, and they're classified. So if you're a speculator, your position is classified one way, and if you're a hedger, it means that you're a large producer. So Exxon, for example, in the oil market is a hedger, but a hedge fund would be a speculator. In the gold market, oh God, I forgot the big gold producer. Whatever, one of the big gold, I forgot the name of the gold producers, Goldfield Mines or whatever. All of the big gold producers are hedgers because they're actually physical producers of the product. So they're using futures as a hedger. And what he looks at is the difference between what the actual producers of the product do and the speculators. And when that ratio gets extreme, so if speculators are all long and the hedgers are all short, generally it's always on the opposite side. The guys who produce the product are always on the opposite side of the guys who speculate. Then that creates a very powerful signal that the market is going to go the other way. In other words, the hedgers are kind of like the market makers. They are usually always right. And what we saw in both, gold and equities, and on the equity side, the hedgers I think are the big money center banks. They're considered to be the hedgers in the space, and speculators is everybody else, us and the hedge funds. Everybody was incredibly short equities, so squeeze was just in the making. So he has proprietary measurements of how those things work, and he's got a certain interesting setup that he works out. And as a matter of fact, I'm going to be posting a lot of we're going to be. Should I pitch the Trader Fest here to let everybody know that we're going to be hosting a very
absolutely. Tell us about it.
So in end of July 23rd, we're going to be doing our annual Trader Fest. As everybody knows, that is my labor of love. It's basically this completely free trading festival that I put on every single year. Invite some of the greatest traders in the world to just share a lot of their ideas. This year, it's going to be really fascinating because the topic was going to be AI and systematic trading. So there's going to be a lot of interesting, talks about that. But in order to kind of make you understand just how valuable this event is, we're going to start to post a lot of old content from former Trader Fest, and one of them will be Jason's setup on how he trades this stuff. And his whole idea basically is if you have a very, very skewed market, everybody is short the market, and you have some negative piece of news, and the market actually goes up on that piece of news, that is the turn. That is his turn, and then he gets long from that and just starts to trade the market. I think what happened was, I forgot, like about a month ago, we had some, maybe it was bad CPI data or something like that, and the market actually ended up stronger. Like meaning the CPI was hotter, and the market ended up stronger today. He went long, and it was a great call. So there's a lot of Kathy. Also looks at sentiment. So, Kathy says like a three tripartite system, which is fundamentals, technicals, and sentiment. And I think sometimes sentiment gets a short shift, but in fact, I would argue that sentiment is probably one of the most important, if not the most important. It's the tilting factor. If you got everything kind of even, it's the tilting factor that's going to make a difference between whether things go one way or the other. So really important to study that. Of
course, share with us how a trader would find or observe and make decisions based off sentiment.
Well, the COT report is public. It's published every Tuesday. It's a little bit late, so it's sort of like has a little bit of lag time. But if you're more of a positional trader, you certainly can find it. Also, a lot of brokers will post their book. Like many brokers across the world that I know of. I won't mention all the names because our favorite broker that we work with. ACAP, and that's the only broker you should deal with. But the point is that there's lots of broker information across the world, and I'm happy to actually maybe I'll create a little Google spreadsheet next time we're here, and I'll share with everybody. They actually publish their own retail traders position, right? So like our book is 85% long euro or 70. Like for example, one broker I saw over the weekend posted that their book was 65% short US 30. Like there was people are still shorting shorting equities, which means that it's very likely we're going to squeeze higher as we
Right.
go. So you could see the idea being basically is if you're on the side of the crowd, if you're on the side of the majority, especially if you're on the side of the retail crowd, you're probably on the wrong side of the trade. You probably, not always, it does, like always, it doesn't always work that way, but it works that way enough of the times to make it a really meaningful signal, and that's how you.
Right.
I also have a bunch of tutorials that I posted on YouTube. If you stop sharing your screen, Boris, I'll show my screen. If you want to learn how to use sentiment to trade. So our YouTube channel is BK4X, is YouTube/BK4X.com. You can just use the search button and just type in sentiment and then hit enter, and you can see I have videos on how to use sentiment to trade Forex, my favorite risk on, risk off trades. So there's different, so you can watch this video, people love it, on how you can gauge sentiment on a day-to-day basis. And this week I actually posted my 10-minute fundamental analysis routine, which people really like. I got a lot of great feedback on that. So
Awesome.
if you've got questions about fundamentals particularly, that's my forte. I do a lot of videos on this stuff, like how to use stocks to trade Forex, how to use bond yields to trade Forex, how to trade central bank rate decision. So lots of great stuff over here, and lots of new trader tips as well.
Awesome. So somebody could come in and essentially pick out 3 or 4 of those videos and come up with a little trading strategy.
Yeah, absolutely. Or, we just get so many questions about fundamentals from traders, and, there's a lot to learn here, and, it's just jammed full of good information.
Very cool.
So we do have a few questions on YouTube. One of them is, can you explain ISM subcomponents interpretation, especially about new orders and inventory components? So I think if you look at the calendar, let me see, today, is my calendar changing? No.
Not yet.
All right, let me stop this and change to my calendar. Okay. So has the calendar loaded already?
Yeah,
Just popped up.
Yeah.
Great. So ISM Manufacturing Services has a lot of guts, meaning there's a lot of subcomponents like the employment report, business activity, new orders, and prices. The most important, obviously the number one most important is the headline number, right? As ISM services. And, people look at that to see whether service sector activity is, growing or contracting. And the benchmark is the number 50. If it's above 50, it means that the activity is growing. If it's below 50, the number is contracting. And then they look at how is it compared to the previous month. So you can see here, the U.S. service sector is barely growing. It's pretty much at 50.3, which is pretty much neutral. And it's also a slowdown from the previous month. And, DailyFX does a good job of showing you, the chart too, so you can look at where it is on a historical basis. Now, the details are measured the same way. They're all against the 50 number. And people look at it as how does it compare to the previous month. So employment, really bad news. I mean, it shows that the service sector is actually seeing a contraction in job growth. So this is really interesting, Corey, because there's a lot of questions about the NFP report that came out last week. The headline number was really strong, 339,000, I believe. But the household survey, which is what the unemployment rate is based off of, actually showed, I think, like 200-something thousand job losses. And so people say that if the non-farm payrolls number was adjusted for, was adjusted for the birth-death model of businesses, that job growth would have actually been much weaker. And that's kind of what this number that you're looking at right now, ISM Services Employment, is telling us as well. It's telling us that really, the labor market may not be as strong as that headline number showed us on Friday. And that's kind of the reason why the dollar sold off of this report. So for the person, Satish, that's asking about the subcomponents, the headline number is very important. The services number is employment number is very important. And then I think the only one anyone really cares about is prices, because that's obviously a measure of inflation. And they want to see, has there been a major change in the price component? And in this case, the price component did fall a little bit, but these are the 3 things that people look for when they're trying to analyze the details. But usually it's just the top line number and employment. Another question, I think it's not really so much a question,
Great.
but say,
I have a counterpoint to the whole ISM household model argument. So the household model argument is incredibly noisy. It is it literally just goes up and down like a bipolar patient every single month. That's why nobody who studies macro really looks at it very, very seriously. The whole point of the top line number is that it's standardized by the BLS to be much more accurate of the descriptive of the employment. The other thing about ISM services or any of the ISM data is it's what's called a diffusion index. This is just a survey. It's not an actual measurement of how many people got hired, how many people got fired. So I understand the argument that the economy is weakening, but I think you could take that, you could make just a very strong counter argument. You could take all of those counter arguments with a grain of salt, that none of them are factually confirmed on the other side, just as they may not be quite factually confirmed on the positive side. So I think, I guess my argument is until we see definitive proof, you have to assume the economy continues to grow relatively well.
All right, so we have some other questions about charts about pound dollar and euro dollar. So I'm going to stop sharing and reshare. Although I should probably just share my tab.
I want to ask you about pound dollar. Do you have any views? Because I saw a flash tweet today from somebody that true-flation, which is like a hyper fast measure of inflation, in the U.S. was 2.45. In UK was 13.45 still. Like it's unbelievable how much more inflation there is in UK. I was wondering if you had any.
Sterling's the worst performing currency today. And a large part of the reason why it's the worst performing currency is because there's not much going on from the UK this week. We have very little data. This morning we had the PMIs from the UK that were revised lower. I think the Bank of England is near the end of its tightening cycle. You're absolutely right. Inflation, like everywhere else in the world, is the biggest problem. It's sticky. It's not falling. UK in particular is a lot higher than everyone else. And for those of you that are in Twitter Spaces, make sure you go onto the YouTube link because there's a lot of you that are not seeing the charts that we're showing. So the UK inflation is very, very sticky. And that's part of the reason why sterling's hovering near its highs. But I think that we are at a point where we're going to start to see underperformance in sterling. This chart here tells me that sterling could potentially drop down to 123. We are below both the 20 and 50 SMA. If we go to a longer term chart, like the weekly chart, it's just kind of grinding between 126, 123, and it's not, and there's no real data this week to move it out of this range. So what I would say is that, with the sterling, with the UK, I like in particular euro pound. I think euro pound has fallen a lot. It's this was the lowest level we've seen euro pound year to date last week. Very strong move lower. BOE near the end of tightening cycle. Both Eurozone and UK kind of grapple with the same type of hot inflation pressures. So I think, I really like euro pound to the upside as a near-term opportunity. For those of you asking about euro itself, we talked about this a little bit earlier. We talked about how the ECB has been uber hawkish in contrast to the Fed, who's been cagey about what comes next in June. So I think euro itself could start to drip upwards towards 108, maybe even 108.50. And I also think, for those of you that are joining us late, we talked a lot about how, this week is probably a week where we're probably going to see profit taking in the greenback because, the one piece of big data we had is already out and that was weaker. And also, the Fed is talking about skipping the June rate hike. So that this view would be of the euro rebounding up to 108, 108.50 would be consistent with the fundamentals.
Got it. Thank you, Kathy. Boris, I have one quick question for you on the Trueflation tool. What is you said it's about 13% in UK. What's the official estimate?
I think it's like around 9 or 10. I mean, but this is a sort of a hyper fast. What they do is they measure thousands of products on the shelves of stores. So it's it uses technology to just kind of really give a real bird's eye view of inflation. So yeah, I mean it's interesting. I think it's
yeah, definitely. It'd be interesting to see as time goes on what kind of divergence it has from true estimates.
Exactly.
Do we get closer or further?
Exactly. I mean, I wonder, like, with this whole conversation about AI and everything else, I wonder, all of this stuff, if you think about all the economic data that we're using, is incredibly, and it's just like, it's no different paper, pen and pencil. Like, it's just guys going
Right.
out there asking questions. And I wonder if we're going to get to a point where we're going to have software agents that can give us much better, much faster, much more precise data, on the thing. Sorry, I'm just watching my trades here. Take profit. Thank you. And I wonder if we're going to very soon actually radically change not just the way we trade, but the way we collect data. So it's going to be it's one of those things.
Yeah.
That's why I'm very excited about this Trader Fest. We're going to ask a lot of very interesting existential questions.
Are you bringing in AI experts?
Yes, I'm bringing people who are. I'm less interested about AI. Like, I don't. It's not going to be a one. It's about trading. It's about how to use AI in trading. We're gonna bring in a lot of people who use a lot of tools that are available now to the common person to help their trading, to make their trading better. But like, we'll also ask the much more interesting macro questions of some of our guests. We're gonna have panels. It'll be a lot of fun.
And when is it again?
The slated date is going to be July 23rd.
Okay, great. And where can people find more information about it?
I'm teasing this.
Follow us on Twitter, and when the details are out, we'll be posting it. So my handle's right there, Kathy Lean FX, and Boris's handle is FX Flow.
Right.
Perfect. Yeah, definitely. Sounds exciting. Something worthwhile.
Really exciting, and we'll be talking a lot more about it. As the month comes to a close, because it's really a July event, so we're going to get everybody excited for the July. I'm just kind of teasing.
Awesome. Boris, do you have any trades for us? You got any trades going off? I know you said you just took some profit.
Yeah, well, I'm scalping. I'm scalping. I don't have not necessarily that I have a trade. I have I don't know if I want to. What I was going to talk about is how sometimes it's very, very important to flip what you're doing upside down on a setup, because let me share my screen. I sort of try
as we're speaking, Corey, you're looking at my dollar yen chart, and how we talked about how dollar yen is probably at a peak. And at that time, dollar yen was hovering around 140.06. And here, beautiful. I can't really take credit for this fast move, but beautiful 70 drop, just as we're talking about how the dollar, especially if you started with us right at 11, we were all over this dollar pullback trade.
We sure were.
So let me stop this so Boris can share his.
I'm actually pulling because I'm like wondering if, because I have like all these signals on my dollar yen, which of course I ignore because I'm not really paying attention to FX. But why is this not sorry, I'm trying to put on my indicator here. Just for a second, let me see if I can.
So while he does that, we have a question about the Australian dollar and whether the Australian dollar will sell off if the RBA pauses a rate hike tonight, which is tomorrow in Australia. That's what is expected already. And this is where expectations versus action is very important. Because when the move is already expected, the action that it yields would be nothing, right? Or very little movement, because the central bank is doing exactly what the market already anticipates. So it won't be about what they do. It's going to be about what they say. And that will be true for the Reserve Bank of Australia, the Bank of Canada, and in general, that's true of every central bank meeting. They could do something, but what really matters is what they plan to do afterwards, their guidance. So if they pause tonight, that's going to be a given. I don't think that that's really what investors are going to latch onto. Maybe it'll sell off a little bit, but I don't think it's going to be a sustainable move. Whether or not it's a sustainable move will be much more contingent upon what they say. Whether they say, we're still thinking about raising interest rates. We're still in rate hike mode. In that case, we could actually see Aussie rally, because that would be reinforcing what the market thinks is going to happen, which is that a rate hike will resume in August. So it's always about the guidance and not about the action.
Oh yeah. So I found I had like all these alerts go off on me because.
What is this, Boris? Why don't you spend a little bit more time telling us what this is?
Yeah, I'm just about to. Yes, this is.
I can't see it. You need to zoom in.
Okay. Let me know if you guys can see this very well. It should say the word. It should say the word tidal wave on the screen here.
Not yet. Keep going.
No,
No, I can't see the word tidal wave at all.
really.
Keep
Like
going.
over here?
Can't see it. Can you see it, Corey?
No, I can't. Looks like the text boxes are staying small, but just
Don't you-
the candles are getting big.
Don't you have the larger
Okay.
text box version?
Sorry, what?
You have the larger text box version.
This is a large text box. But for some reason, the screen is not expanding the text boxes. I don't know why. But you'll have to trust me on this. Wow, that's weird. I really see they're huge on my screen and they're not big on this. Let me just see if I can get it any bigger.
We're the ones that matter, right?
That's right.
Not you.
Can you see this?
Yeah, relative now
Barely?
they're tiny. I mean, they're smaller than the candles now.
I don't think it's gonna work.
It's not gonna work. I guess it's not working.
But it's fine. Basically what it should say is the word tidal wave, which is a strategy,
Well,
and we just need to work on making it bigger.
yeah, no, this is as big a size, but I guess it doesn't expand on the screen for some reason. Anyways, as you can see, there's a red box over here, and I'll just read to you what it says. It says tidal wave sell 140.26.5 or 140.
You know what? Hold on, Boris. Can you stop your screen? I have a big version. I don't know why it's not showing up on yours. Stop your screen. I'll show my version.
Okay. I think it might be my monitor because my monitor I got a super high res
Because
monitor.
you can see this now, right, Corey? Look at that, Boris.
Yes. Yeah.
Yes. Yes.
Totally
Sure can.
Yeah, it might be my monitor. It's probably the resolution on my monitor. Okay, so that's fine. So we'll just use Kathy's screen. So can you go to the 5? Is this a 5-minute chart, Kay?
Yes,
Yeah,
sir.
Okay.
Yep.
So you see, I had a whole bunch of signals kind of go off. So this is a proprietary indicator, an exclusive indicator that we developed for BK Forex, and it's a really cool indicator that really works very well with FX, especially in dollar yen is one of my favorite pairs to work on. It's basically based upon the idea of momentum preceding price, right? So a large move in momentum will signal a large move in price, and it doesn't matter where you are on the chart. Like if there's a big up momentum, then we're a buyer. If there's a big down momentum, there's a seller. So sometimes that could be off of a reversal move. Sometimes it could be a continuation move. In this case, you can see dollar yen at around 4 o'clock in the morning, New York time, signaled on a 5-minute chart the short at 140.26, a sell. Now, what's very cool about this particular indicator is it will tell you the stop, the target, and the risk reward. And the default here is a 1.5 to 1 risk reward ratio, right? It also will mark the actual trigger candle as yellow, right? But if you wanted to change risk reward to 2, for example, I don't know if Kay, if you want to go into the setting wheel, can you go into the setting wheel?
Yeah, I just don't know which one's showing. While I'm changing this, can you explain why one of them has a stop of 15 and the other one has a stop of 53?
Yes, because the stop it's all dynamic, and this is the other beautiful thing about this. The stop is based upon the high of the trigger candle, right? So if you're in this particular case, the trigger candle is very short, so you only have 15 points of stop. In the other move where you have a large momentum move, you had a whole 53 point pip move. So one of the ways that you want to trade this is very important, is you want to make an equal amount of bet irrespective of what the stop is. So if you're betting $10,000 on a 15-point stop, you want to bet the same $10,000 on a 50-point stop, but you would just bet a lot less. Your size would vary based upon the size of the stop, but you want to make the exact same dollar money bet on the thing. So for example, she's right now has it at 1.5, but go ahead and set it to 2, okay? Just backspace and make it 2.0. And you'll see right away without anything changes. You see how the green line moved down. It moved down over here, and it created a larger risk reward ratio. It gave us a bigger target than the original target. And you could the cool thing about this is you can go back on the chart and see, what would have worked better? Would it be better if I did a 1-to-1, 1.5-to-1, 2-to-1, whatever you want? And you see it allows you to have the flexibility to measure what is the ideal risk reward ratios for all this stuff. Generally, and I'll save you the trouble. everything I've ever studied, and I've let other guys who are much more sort of quantitative than I am, literally test thousands and thousands and thousands of stop, risk, and reward ratios, and inevitably they always come to the idea that between 1, 1.5, and 2, the absolute sweet spot is 1.5. It's big enough to give you a net positive expectancy, but small enough so it can be made. Because 1.5 to 2, or 1 to 2, is very hard to reach that 2 reward against the 1 risk most of the time. So it's the highest probability with the greatest P&L. That's why I have it set to 1.5 to 1. But of course, you may have a different view, you may have a different point. But you can see, for example, you see that green line over here. Here's a buy that would have made target. You had 3 consecutive trades. Think about this: 3 consecutive trades, 1.5 to 1R, which means that if you had 3 negative trades beyond that, you would still be, and actually 4 consecutive trades. This is a 4th one. So 4 times 1.5 is plus 6, right? Minus 4 times 1 is minus 4. So if you were just 50-50 on this setup, you're already plus 2 on the whole trade, if you think about this. And if this setup is a little bit better than 50-50, you're wildly more positive than you should be. And that's why it's so interesting and so positive. Now, what's funny is I think I actually I originally had this configured on a 15-minute chart, and I never looked at this at a 5-minute chart because it was I think I just made a mistake, and I forgot to add the
Boris,
one.
before you jump over there, would you run this through your framework? The what, when, how?
No, because this is a completely I shouldn't say no so fast. You're absolutely right. You actually do want to run it through this framework of what, when, and how, in a sense of like the best currency pair, in my opinion, for this kind of stuff is the dollar-yen. Because what is this setup all about? This setup is all about momentum and movement. What's the single biggest moving pair in the currency market? I mean, what moves 150 points a day? Name me any other FX pair besides pound
Right.
Kiwi. No, pound Kiwi would also.
Euro CAD. Lots of the Euro pairs move that much. I trade Euro pairs all the time.
Okay,
But yeah.
and those would be good. Let me rephrase that. What amongst the majors moves? Let's
Pound dollar, right?
Huh?
Pound dollar does.
Pound dollar is the only other one, right? But that's my point. My point is that if you want to choose the absolute best, those two are really, really good currency pairs.
Let's see how pound dollar would have worked. I don't really trade pound dollar.
Yeah. Pound
Yeah.
dollar.
This is a live trade, so we don't know yet. This one
did not quite reach target.
Did not reach target.
We all know pound dollar is.
This one worked out.
Yeah.
This one
But
hit target.
we all know that pound dollars is where FX traders go to die, right?
Yeah, I hate trading pound dollar.
That's why, because pound dollar is notoriously backtracking system. I actually have a different indicator that works really, really well with pound dollar, because that's, again, you're right. What does matter? No human beings are alike. No currency, no instrument is alike. Each have their own proprietary characteristics, right? Yen right now is a very trending, very momentum trade. It's a great trade for this particular setup. So yes, the what definitely does matter, and the when, I think, you're absolutely right. You wouldn't trade this in front of news. Like, this is a signal post news, right? This is a signal post. I'll take it post news, but you would never take the signal if it was 5 minutes before news, because it's just stupid to do that, right? And then, of course, the how, which is how this structure works, is how you would apply it. So you're right. I take it all back. You're right. What, when, how very much applies to FX, the same way that you would trade it for anything else. And you see actually how the what, which is the single most important question, gives you completely different results if you're trading dollar yen versus trading pound dollar. That's why, I think that's the art of trading. You can have great algorithms. You can have great indicators like I've made for you that give you. And by the way, the other cool thing about this is this indicator is fully automated for alerts, right? So I'm not going to force Kathy to set up an alert here, because, I need to show you how to do it. But you literally can set up alert, and it just tings you. And you anywhere on your phone, anywhere else, you can see, it has a trigger trade. You can take the trade with great ease. So you could automate huge amount of dirty work, of what I call really low level, just clerical work that nobody ever likes to do, right? Finding trades, finding alerts, finding the situations. All of that can be done, I think, beautifully with AI and algorithms and programming. What can't be done is judgment, and that's where the what, when, how structure comes in. That's where the art of trading still, I think, remains in the human mind. So that's
Nice.
my
So
final.
these are
Good
the type
explanation.
of indicators. These are the type of indicators that BK members get access to, and as part of their membership. And so these custom designed indicators are pretty cool, and we go over them. We talk about the different opportunities that come out from them.
Oh,
Awesome. And
absolutely.
when did this one? Is this brand new?
These are
Yeah.
brand new.
Nice.
Forrest, I don't know if he will admit it, but he designed it using AI.
He shared that with me last week. Actually, he
Okay.
said he was working on something.
Yes, these are all coded with the AI. This is probably my favorite one. This is like my favorite child. I love this. This is literally like the best. It works great on US 30. It works great on oil. It works great. You name me. It works great on Nasdaq. You name me a momentum-based instrument that moves, that has continuity moves, and this thing will catch those moves, especially at 1.5 to 1, where it has a positive expectancy. They're so rare. It's so rare to find positive expectancy trades. Contrary to every YouTube guru who'll tell you, oh, here's all my 10 to 1 risk reward ratios. In real life, it's really, really hard. That I really like this setup because it's kind of works that perfect line between good risk reward ratios and positive expectancy. And
So
you
here's a
could
really nice US 30 trade that we got
There you go.
using
There
the
you go.
tidal wave.
Right,
This one,
right.
is very small risk reward, which is fine. I mean, the stop is 19 pips. The here you're getting for a much bigger move.
Yeah.
That also goes to the when component, right? Because when you see a lot of this stuff, when
Yeah.
you see this up and down, that's almost
Yeah.
inevitably that is news. I 100% guarantee you that is news. That's not something you would take because that's the algo just simply executes the algorithm, right? It's not smart enough to understand the context, right? So that's
Right.
news. I 100% guarantee you whatever the hell that was, what time of the day that was. It's a 9:30. Yeah, it was clearly some. I think it was NFP. I don't even know what that was, but
No,
it's
it
clearly.
probably would have been like maybe ISM because this is a Thursday, so it's like the equity market open, maybe the
Right.
debt, not the debt
Right.
deal, but something else going on.
Something something else
You
going
know,
on.
this segues into a question that I think is quite interesting that someone's asking. Do you think the best time to trade NASDAQ and US 30 is after the New York Open fake move?
100%. That's what we do. That's what we do all day long in my room. If you want to come, I'll share with you next Monday. I have what I call the golden New York Open set up right now, and it's actually and I came up with it. We actually traded it today, and it banked out on Nasdaq and it banked out on US 30. I actually came up with it by flipping my whole worldview upside down. I can talk about it next week. It's a very interesting idea. But absolutely, the single highest probability trades you can possibly make are at the New York Open once you understand what the New York Open is and once you understand which way it goes. And using our balanced infrastructure of highs, midpoints, and lows, it really opens up your eyes to finding out where the highest probability trades are. If you can catch the momentum, I mean, today, it took us to 2 tries today, and it really it was a lot of volatile movement, so it drew it down a lot, but it actually came out and banked out beautifully for us as we traded
Nice.
it out. So
Very nice.
I love this setup, and what's really, really cool about this is it's a relatively low, typical to what we do, relatively low risk reward setup. So you could trade it with much larger size and much larger accuracy. That's going to be the foundational core, the engine for our pass the prop test structure for how we're going to be doing it. So definitely come to my room. I'll be happy to show it to you.
Awesome. Well, thank you guys so much, Kathy. Before we go, I love to see the heat map. Would you pull up the heat map for the week and just run us through it?
Yeah, certainly. So this is our heat map. I'm still, even though I think there's going to be a pullback in the US dollar.
You're still showing charts.
Sorry about that. 1 second. Okay, here we go. So, even though I think the dollar is going to pull back this week From a broad perspective, I still think that the US dollar is going to outperform. We just have to be a little bit pickier. So I would say this is neutral bullish dollars. I'm still, kind of bearish euros, especially against some of the Canadian dollar. We shorted EuroCAD this morning, and that turned out really well. And we're also in Euro Swiss. So you have to be selective. But I think Eurozone economy has been doing great. UK, I'm neutral. Aussie, I'm neutral going to RBA. I'm bullish the Canadian dollar. I'm still actually long the CAD against the greenback right now, and it's working out nicely. I'm neutral the New Zealand dollar because there's nothing going on. And right now we are bearish the Swiss franc and the Japanese yen because I think the debt deal and I think some of the good US data is going to keep stocks supported, even though we have a bit of a pullback today.
Awesome. Very cool. Well, thank you guys again so much. And we will see you on next Monday to hash out what goes on next week with the FOMC. And I hope you guys have a great week, productive and